Welcome to The Explainer. Today, we're doing a much-needed reality check on something you've probably seen flooding your social media feeds. We're unpacking those flashy and, let's be honest, sometimes totally outrageous claims made about binary options strategies. You know the exact ones I'm talking about, right? The influencers promising you can just quit your day job tomorrow with a few simple taps on an app? Well, we're going to push past all that hype, look at the actual data, and find out what's really going on behind the scenes.
$7,206. That right there is the exact kind of hyper-specific number you'll often see clickbait sources throw around to boast about their supposedly simple trading strategies. They'll show you an account balance to shooting up, a screen absolutely covered in green numbers, and suddenly, you're led to believe this is just easy money, literally waiting to be claimed.
Naturally, seeing numbers like that makes us all wonder, right? Like, can a strategy really produce those results consistently? It's a totally fair question. But honestly, the real question, the one we actually need to dig into today, is this. What happens when that exact same strategy inevitably starts losing?
Okay, so let's dive into this. Here's our roadmap for the explainer today. First, we'll cover what binary options actually are. Second, the brutal payout math. Third, the four-step strategy we see promoted so often. Fourth, some seriously dangerous traps you need to avoid. And finally, the red flags and regulatory realities.
All right, starting off with Section 1, what exactly are binary options?
Think about it this way. When you buy a traditional stock, you're actually purchasing a real asset, right? Like a tiny piece of an actual company. But a binary option? It's really just a yes or no proposition with entirely fixed outcomes. You're basically just predicting if a specific condition will be met by a very strict deadline. You don't actually own the underlying asset at all, not even a little bit.
Let's actually look at how the SEC's investor.gov officially defines them. They describe binary options as contracts whose payout depends on the outcome of a yes or no proposition, with the holder receiving a predetermined amount of cash or nothing. I really want you to mentally highlight that or nothing part. It's an all or nothing structure. You're either right and you get a predetermined payout, or you're wrong and you lose exactly what you risked.
Moving on to Section 2, the brutal payout math. And yeah, brutal is definitely the right word here.
Now, what's really interesting here is how the math actually breaks down. Let's say a platform offers an 80% payout, and you decide to risk $100 per trade. Win 5 trades, you make $400 in profit. Great. But lose 5 trades, and you lose your full $100 risk every single time. That results in a $500 loss. So at a 50-50 win rate, you're actually down $100. You don't just need to be right half the time, you have to actively overcome a mathematical deficit just to break even.
The SEC and CFTC have actually specifically warned about this exact negative expected return structure. Think about this for a second. Even if you somehow manage to boost your win rate to 60%, which, let's be real, is genuinely tough for any trader, and the payout happens to be 70%, risking $100 a trade gets you $420 on your 6 wins. But those 4 losses, they cost you $400. Your net profit after 10 whole trades is just $20. A 60% win rate barely, and I mean barely, breaks even before you factor in any other costs.
Which brings us to Section 3, the 4-step strategy breakdown.
Okay, so here is the framework you see heavily promoted everywhere. Step 1, find the trend using the 20 and 50-period exponential moving averages. Step 2, wait for a pullback to those averages. Step 3, check your momentum using the 14-period RSI. And finally, Step 4, wait for price confirmation. The absolute crucial takeaway here. This is a probability game. You never, ever enter a trade just because some moving average is crossed. You got to be patient.
Let's compare a hypothetical call versus a hypothetical put setup. For a bullish call, the 20 EMA has to be above the 50. The RSI must recover on a pullback, and the price actually has to break the short-term high. Now, for a bearish put, you just reverse all of that. 20 EMA below the 50, a bearish RSI, and price breaking a short-term low. Both of these setups require strict discipline. You have to react to actual confirmation, not just try to guess the future.
All right, Section 4, dangerous traps to avoid. This is absolutely crucial.
The first massive trap you'll encounter is the expiration timer. See, direction plus timing is the literal only way to win a fixed expiration trade. Unlike traditional stocks where, you can just kind of hold through a temporary dip, with binary options, correctly predicting the market direction doesn't mean a thing if your timer runs out 2 minutes early. You literally have to be perfect on both direction and timing.
And this brilliantly illustrates the second and arguably most destructive trap, the martingale system. This is when traders double their risk after every single loss, hoping just one win will magically recover everything. Look at how incredibly fast this escalates. You start out risking $10, right? But after just a few normal losses, you're suddenly risking $640 on a single trade just to get your original $10 back. It is a catastrophic amount of risk, no way around it.
The better approach, assuming one were to actually test these concepts, is fixed risk. The absolute key thing you should take away from this is to never, ever increase your trade size just because the previous trade lost. You have to maintain that emotional discipline. Whether you just won or lost, your very next trade should use the exact same risk parameters and follow the exact same rules. The strategy shouldn't suddenly change just because you're feeling a little frustrated.
Now, for our final part, Section 5, Red Flags and Regulatory Reality.
When you see those flashy influencer screenshots we talked about earlier, keep in mind what they intentionally leave out. A simple screenshot doesn't show you their starting account size, how many total trades were taken, the maximum drawdown they suffered, whether it's even a live account or just a fake demo, and most importantly, if they were ever actually able to successfully withdraw that cash. Always remember, a single profitable session is definitely not a verified track record.
And that brings us to some very specific regulatory warnings from our sources. For example, regarding a super popular platform you see touted in these videos all the time, the UK Financial Conduct Authority currently lists PocketOption on its warning page. They explicitly state the firm is not authorized, and this page was updated as recently as February 10, 2026. This is a matter of public record that we're reporting on here, and it's a major warning sign that any prospective user needs to be fully aware of.
Furthermore, the main regulatory bodies for our U.S. viewers, the CFTC and SEC, have issued some broad and very serious warnings of their own. They state that many online platforms are not registered and may expose customers to fraud, withdrawal problems, identity theft, and alleged manipulation. The big lesson here: always verify a platform's regulatory status independently before you ever deposit a single dollar of your own hard-earned money. Just because a website has a slick app and looks professional absolutely does not mean it's legally operating.
So what's the practical takeaway from all this? Well, if you're genuinely interested in studying the mechanics of short-term price movement, apply what we call the demo-only test. Use historical charts or a completely risk-free demo account. Record 50 to 100 setups. Diligently track the time, the trend, the RSI, and brutally verify if you actually followed your own rules. Basically, collect your own data and study the process instead of blindly believing those guaranteed profit claims you see online.
And that brings us to the end of our explainer. But before we wrap up, I want to leave you with this final thought. Would you rather trade a high-risk binary option setup where fixed timing and brutal payout math are constantly working against you, or use a traditional stock or option strategy that gives you much more flexible risk management? The choice is entirely yours, of course, but now you've got the structured facts to make an informed decision. Thanks so much for joining me today. Stay disciplined and keep learning.